Welcome to This Explainer. Today, we're equipping you, the aspiring startup founder, with the exact knowledge you need to make your very first, and honestly, your most absolutely crucial business decision, choosing your legal structure. Think about it. When you build a house, you definitely don't start with the roof, right? You start with the foundation. Well, for your business, that foundation is your legal entity. So picture this. You're standing at day one of your exciting new venture, looking down two diverging paths. Down one path, you've got the traditional partnership. Down the other, the corporate structure. And here's the thing. Each of these comes with its own unique blend of risks, rewards, rules, and, costs. We really need to figure out which route is going to secure your future and give your business the runway it actually needs to thrive. Section 1, the Startup Founder's Dilemma. Section 2, the Partnership Path. Section 3, the Corporate Route. Section 4, Head-to-Head, Key Differences. Section 5, the Cost versus Liability Checklist. Section 6, Making Your Final Decision. Section 1, the Startup Founder's Dilemma, your first major decision. We're starting right at the crossroads because the foundation you pour today is totally going to dictate your long-term risks and rewards. The structure you choose, it's not just boring paperwork. It directly impacts exactly how much you pay in taxes, who actually calls the shots, and, most terrifyingly, whether your personal savings are on the line if things go completely sideways. It's a massive balancing act. Are you looking for maximum control with minimal setup costs, even if you have to swallow more personal risk? Or are you willing to deal with expensive government regulations and potential double taxation just to get an ironclad shield around your personal assets? Section 2, the partnership path. Easy to start, but what are the risks? Okay, so a partnership is basically a business with two or more owners that hasn't officially organized as a corporation. The great thing? It's incredibly easy and inexpensive to organize. You generally don't need any special permissions or state charters to get it off the ground. But we have to talk about something called mutual agency. In a general partnership, every single partner is a mutual agent of the firm. That means any partner can legally bind the business to a contract. So imagine your business partner goes rogue and signs a disastrous, wildly expensive contract on behalf of your company. Guess what? It binds the entire business. You are personally on the hook for their decisions as long as it falls within the scope of the business. Crazy, right? And that leads us straight to the terrifying twin of mutual agency, unlimited personal liability. Because a partnership isn't a separate legal entity from its owners, you and your partners have unlimited personal liability for the business's debts. If the partnership goes under and can't pay its creditors, those creditors don't just stop at the business bank account. They can come directly after your personal assets. We're talking about a failed venture literally draining your personal checking accounts, your investments, and just about anything else you own. But hey, it's not all doom and gloom. Despite those massive risks, partnerships offer some pretty incredible advantages. The biggest one, the partnership entity itself actually pays zero business income tax. It's something called pass-through taxation. Basically, the net income, or the loss, flows directly through the business straight onto the individual partner's personal tax returns. So you completely bypass that dreaded corporate double taxation. You just pay personal income tax on your slice of the pie. Do keep in mind, though, a partnership has a limited life. If a partner leaves or passes away, that original partnership legally dissolves. Oh, and any property you bring into the business instantly becomes co-owned by the partnership. Section 3, the corporate route, the shield of a separate legal entity. Now, if you go the corporate route, things change dramatically. A corporation is organized under state law and exists completely separate from its owners. Ownership in this setup is divided into shares of capital stock, which are sometimes represented by physical stock certificates for the business. This system is kind of brilliant. It makes transferring ownership a total breeze. Want to bring on a new investor? Just issue them shares. Does a founder want out? They just sell their shares. Because of this, corporations can raise vastly more capital than a standard partnership ever could dream of. But this structure introduces a really fascinating dynamic when it comes to control. In a general partnership, the owners are almost always the ones running the show day to day. A corporation, though, often splits ownership completely apart from management. So, as a stockholder, you absolutely own a piece of the company, but you're probably not managing the daily grind. Instead, stockholders elect a board of directors, and that board appoints officers, like a CEO, to actually run things. Meaning, as an owner, you might not get a direct say in daily operations at all. It fundamentally changes how control works in your startup. The corporate trade-off is pretty much the exact reverse of a partnership. The absolute biggest perk is that stockholders have zero personal liability for the corporation's debts. Your personal risk is strictly capped at whatever amount you invested in your stock. Period. Plus, corporations boast an indefinite continuous life. They don't just disappear if an honor leaves. But, and it's a huge but, here comes the ultimate double-edged sword. You pay a high price for that ironclad protection. We're talking expensive government regulation, significantly higher startup costs, and the infamous double taxation. The corporation's earnings get taxed first at the corporate level, and then, if any of those earnings are handed out as dividends, they get taxed a second time on the stockholders' personal tax returns. Ouch.
Section 4. Head-to-head. Key differences. The ultimate showdown.
So let's stack them head-to-head on the biggest friction points for any new founder. If you choose the partnership path, you're accepting a limited lifespan, unlimited personal liability, and the very real risks of mutual agency. Why? All to get that sweet pass-through taxation. On the flip side, if you go with a corporation, you lock in the safety of limited liability, a continuous lifespan, and absolutely no mutual agency among the stockholders. The catch? You sacrifice your tax efficiency by subjecting the business to double taxation. Ultimately, it boils down to a direct, stark trade-off between financial efficiency and legal protection. Section 5, the cost versus liability checklist, weighing the trade-offs. To help you actually navigate this, we've put together a practical checklist. Think of this as your founder's compass. First up, ask yourself, can you honestly afford the higher startup costs and those ongoing regulatory headaches of a corporation? Second, take a hard look at your industry. Are you operating in a high-risk field where lawsuits are just part of the game? Because if you are, maximum personal liability protection is pretty much non-negotiable. Third, run the numbers on your expected profits. Can your profit margins actually survive being taxed twice? And finally, look your potential partners right in the eye. Are you truly comfortable taking on their mutual agency risks, knowing full well that a bad mistake on their part could literally cost you your personal savings? Section 6, making your final decision, finding the middle ground. Now, you might be going through that checklist and thinking, man, I really want the tax benefits of a partnership, but there's absolutely no way I'm losing my shirt to a partner's bad decision. Is there a middle ground? Absolutely. You can actually explore some really clever variations of the traditional partnership. Take a limited partnership, or LP, for example. This lets you bring on investors as limited partners, meaning they have zero personal liability beyond their initial investment, while you step up as the general partner running the show. Or there's the limited liability partnership, the LLP. This is a brilliantly designed structure that actually protects you from the malpractice or negligence of another partner. In an LLP, your partner's massive blunder won't automatically drain your personal bank account. It's a fantastic middle ground for modern founders who want the best of both worlds. So as you sit down to finalize that business plan, I want to leave you with one final thought. You've seen the raw data, you've fully grasped the scary reality of mutual agency in a partnership, and you know the heavy toll of double taxation in a corporation. You've weighed the checklist, so what's it going to be? Which trade-off is going to serve as the cornerstone of your startup's legacy? Will you risk your personal liability for the agility and lower setup costs of a partnership, or are you going to pay that corporate premium to build an absolute, ironclad shield around your future? The choice is entirely yours. Thanks so much for joining me on this explainer, and seriously, best of luck building your foundation.
Hey everyone, and welcome to this explainer. Today we're going to embark on a seriously fascinating journey, tracking the complete life cycle of a corporation. We'll start from the very beginning, literally the moment a company is legally born, and we'll follow its path all the way through to the ultimate measure of corporate success, earnings per share. It's a brilliant system of rules and mechanics, and honestly, I can't wait to unpack the whole shebang with you. Let's get into it.
Okay, so here's our roadmap for today. We're going to cover 1. The anatomy of a corporation, 2. Stockholders' equity basics, 3. Raising capital through stock, 4. Dividends and stock splits, and finally, number 5. Reporting corporate performance.
Let's start with Section 1, Anatomy of a Corporation. Defining the entity.
Before a business can even think about issuing stock, it has to be legally born, right? Now, corporations absolutely dominate the U.S. business landscape, and that's because they're organized as completely separate legal entities from their owners. But the crucial point here is weighing the clear advantages against some pretty distinct disadvantages. On the plus side, because it's a separate entity, stockholders have limited liability. That means your personal assets are completely safe if the company goes under. That's a huge deal. Plus, corporations can raise vastly more money than, say, a simple partnership. They enjoy continuous life, and transferring ownership is literally as easy as selling a share on an app. But hey, it's not all perfect. Ownership is often totally separated from management, which means you have to trust someone else to actually run the company. You're also looking at higher startup costs, pretty expensive government regulations, and of course the dreaded double taxation, where the corporation gets taxed on its earnings and then you, the shareholder, get taxed again on your dividends. Ouch.
Moving right along to Section 2, Stockholders' Equity Basics. Who owns what?
You know, ownership becomes incredibly tangible when you actually look at a physical stock certificate. In our digital age, it's so easy to forget that capital stock represents a very real slice of a company. Like the document we're looking at here, it proves that Courtney Edwards holds basic ownership, specifically 288 shares. This is the physical, or I guess digital, proof of equity in the business.
Now keep in mind, there are strict limits placed on those shares. A company can't just print infinite stock whenever they feel like it. Authorized stock is the absolute maximum number of shares the state allows the corporation to issue. Then, zooming in a bit, within that limit is issued stock, which is what the company has actually handed out over time. And finally, at the core, there is outstanding stock. These are the shares currently held by the actual stockholders. Understanding the difference between what's allowed, what's been issued, and what's currently held is absolutely foundational to corporate accounting.
So, when you buy that outstanding share, you don't just get a piece of paper. You gain some very distinct powers. First off, you step into the right to vote on corporate matters, actually helping steer the company's direction. You also earn the right to receive your proportionate share of dividends whenever they're declared. Beyond that, there's the right of liquidation. Basically, if the company unfortunately goes out of business, you get a proportionate share of whatever assets are left over after all the creditors are paid off. And finally, there's the preemptive right. This is super important because it ensures you can maintain your proportional ownership percentage if the company ever decides to issue new stock later on.
All right, Section 3, Raising Capital Through Stock, Funding the Dream.
When a company is chartered, its stock is often given a par value. Now, this is really just an arbitrary legal amount assigned to a share, let's say $1. But out in the real world, investors might be willing to pay, I don't know, $5 for that same stock because they truly believe in the company's future. That $4 difference between the actual issue price and the par value, that is what we call a premium.
Let's see how this actually builds out in the accounting ledger. When Smart Touch Learning issues 3,000 shares for $5 a share, the company receives $15,000 in cold hard cash. So we naturally debit cash. But looking over at the credits, the common stock account is strictly recorded at that $1 par value. So that's exactly $3,000. The remaining $12,000 premium gets credited to a very specific account called Paid-in Capital in Excess of Par. This methodology is brilliant because it perfectly captures both the legal par value limit and the actual market value that investors paid.
Which brings us to Section 4, Dividends and Stock Splits, Rewarding the Owners. So you've made a profit and it's time to reward the investors. But a cash dividend doesn't just magically appear in an investor's bank account overnight. It follows a really strict chronological life cycle. It kicks off on the declaration date. This is when the board officially announces the dividend, which creates an immediate legal liability right there on the company's books. Next up is the date of record. Now, no money actually changes hands here, and no journal entry is made. The company simply reviews its books to see exactly who owns the stock on this specific day, just to identify the recipients. Finally, we reach the payment date. And that's when the cash is actually distributed to those investors, completely clearing the liability.
Now let's talk about preferred stock. This is a special class of equity that basically gets to cut in line for dividends before regular common stock. But pay close attention, because a single word alters an investor's rights completely here. If you own cumulative preferred stock, the company must pay you for any past years they skipped, which are known as dividends in arrears, plus the current year before common stockholders see a single penny. But if you own non-cumulative preferred stock and the company skips a year, well, that dividend is just gone forever. You absolutely do not receive past dividends.
Let's look at the exact math of this, using Greg's Games as a practical example. Say Greg's Games has 1,000 shares of 6% $50 par value cumulative preferred stock. That means preferred stockholders are owed $3,000 every single year. Let's pretend in 2025 the company didn't pay any dividends. Skip to 2026 and they declare a $50,000 total dividend. Because the stock is cumulative, those preferred stockholders get their $3,000 in arrears from 2025, plus their $3,000 for the current year of 2026. That's $6,000 total carved out right off the top. This leaves $44,000 left over for the common stockholders.
Now you might be wondering, what if a company wants to reward investors but doesn't actually want to hand over cash? Why would they issue stock dividends instead? Well, there are three main strategic corporate motives for this. First, it allows them to continue paying dividends while physically conserving their cash for actual operations. Second, issuing more stock drops the market price per share, which makes the stock more affordable for future, smaller investors to jump in. And third, it's a great way to simply reward the current investors by giving them more shares in the company they already love.
There's also another tool companies use called a stock split. Now, this is fundamentally different from a stock dividend. A 2-for-1 split, for example, doubles your shares, but it cuts the par value and the market value exactly in half. But here's the craziest part. Because the total balances of the equity accounts haven't changed by a single cent, a stock split doesn't even trigger a formal debit or credit in the accounting journal. Literally no way. It only requires a brief memorandum entry just to note that the split occurred. How wild is that?
All right, our final stop, Section 5, reporting corporate performance, the bottom line.
When it comes to corporate reporting, there is really one number that reigns supreme: earnings per share, or EPS. Ranks as the #1 most widely used of all business statistics in the entire financial community. It is absolutely crucial to understand the formula. You take the total net income, subtract any preferred dividends, because remember, those guys get paid first, and then divide that result by the weighted average number of common shares outstanding. It tells you, to the penny, exactly how much profit is tied to a single, solitary share of common stock.
Let's pull up this income statement for Kevin's vintage guitars to see it in action. Up top, we see income from continuing operations. That's the sustainable engine of the business that investors watch super closely. But it's down at the very bottom where that critical EPS number is finally derived and displayed. In this specific case, Kevin's generated $4.94 of net income for every single share of common stock outstanding. That is the bottom line.
We've covered an incredible amount of ground today on how corporations are structured, funded, and measured. But as we wrap up this explainer, I want to leave you with a thought regarding how we perceive value versus reality. If earnings per share is the ultimate scorecard of corporate success, does a stock split really change the value of your slice of the pie? Or just the size of your fork? Think deeply about that true nature of corporate accounting the next time a company announces a split. Thank you so much for joining me on this explainer. Keep learning, and I'll see you next time.